Hi guys. Today we will analyze Darden Restaurants stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. Also recent evolutions are not positive. The short-term trend is negative, while the long-term trend is still neutral. It is advised to wait a little bit longer to see how this turns out. Strong support levels are around $114 and $105. Next strong support levels are around $92 and $80. Strong resistance levels are around $126 and $135. Next strong resistance levels are around $148 and $159. In the last month the stock has been trading between $111 and $127.50 range. It is currently trading near the lows of this range. The stock has an average volume of 1.2 million. This is a good sign as it is always nice to have a liquid stock. The stock has been in a downward trend since September 2021. Be careful. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 5% per year, for last 5 years. We see that the average profit margin of the stock has been around 6% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 107% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Darden Restaurants Company: bad, average, and good. First scenario. Darden Restaurants will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 2%. Future profit margin would be low, 5%. Future free cash flow to net income rate would be low, 80%. In this case, the fair value of the stock today would be $50. Second scenario. Darden Restaurants will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 3.5%. Future profit margin would be average, 6%. Future free cash flow to net income rate would be average, 90%. In this case, the fair value of the stock today would be $66. Third scenario. Darden Restaurants will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 5%. Future profit margin would be high, 7%. Future free cash flow to net income rate would be high, 100%. In this case, the fair value of the stock today would be $87. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 7.95. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Darden Restaurants, analysts forecast growth rate around 6% per year in next 5 years, and future P/E around 15. Again, I will use 3 different scenarios for Darden Restaurants Company: bad, average, and good. First scenario. Darden Restaurants will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 2%. Future P/E would be low, 13. In this case, the fair value of the stock today would be $52. Second scenario. Darden Restaurants will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 3.5%. Future PE would be average, 16. In this case, the fair value of the stock today would be $74. Third scenario. Darden Restaurants will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 5%. Future PE would be high, 19. In this case, the fair value of the stock today would be $99. As you can see, today the stock is overvalued, $114, even if we expect the company's high performance in future. While the company has a good profitability rating, there are some minor concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 4-8% yearly. Based on that, the stock looks overpriced at the moment. The stock has been in a downward trend since September 2021, and it can go lower before it recovers. I may consider buying the stock for the dividend when the stock drops below $90. Company's strengths. Darden Restaurants is an American leading multi-brand restaurant operator. It owns 2 fine dining restaurant chains, Eddie's and the Capital Grille, and 6 casual dining restaurant chains, Olive Garden, LongHorn Steakhouse, Bahama Breeze, Seasons 52, Yard House and Cheddar's Scratch Kitchen. Darden has more than 1,800 restaurant locations, and more than 175,000 employees, making it the world's largest full-service restaurant company. This is one of the best-run companies in the industry, and the company's brands are very strong. Darden continues to benefit from efforts to expand takeout and delivery orders, and simplify its menu. Share buybacks, unit expansion, and further cost reductions will lead to EPS growth over time. Improved operating margins at Cheddar's, Yard House, Eddie's, and Bahama Breeze strengthen cash-on-cash returns, and could offer incremental unit growth upside. In 2022, Darden expects to add 35 restaurants and to invest $425 million in capital projects. The company reinstated its dividend, after suspending it during the first months of the pandemic. The current annualized payout is $4.40, for a yield of about 3.85%. The company's return on equity of 45%, return on assets of 10% and profit margin of 11% are amongst the best returns of the industry. Risks. The entire industry has entered a difficult period with sky-high inflation, imploding consumer confidence, labor shortages and supply chain issues. Darden faces the risk that the coronavirus pandemic and weak economic conditions could lead to further reductions in restaurant spending. Like other restaurant companies, Darden could also be hurt by rising food and beverage costs, as well as by increases in the federal minimum wage. Intensifying competition in the casual dining and quick service segments, from significantly larger chains, with global brands, and from third-party delivery services. The company is not financially healthy enough, and could expect problems in meeting its short-term obligations. Based on estimates for the next 5 years, the company will show a small growth in revenue. The revenue will grow by 4-8% on average per year. The earnings per share is expected to grow by 10-15% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.